Today's Saturday, the 9th of March, 2024, and I'm having a look at my open options positions. I did a few trades last week. I sold options over 6 stocks, none of which I own. I collected close to a couple of $1,000s in premium simply by writing cash secured puts over these stocks that I don't own. And today's Saturday, so I'm going to have a look at my positions just to get an idea of where I'm at. So if you've watched my previous videos, you would have seen that over the last week or so, I've sold these option positions. They're all cash secured put options over ANN, BHP, Bank of Queensland, Fortescue Metals, Qantas and Rio. Here's the strike prices. There's sold puts and here's the amount of contracts that I sold in each scenario. So next thing I want to do is calculate how much money I've potentially exposed myself to. And by doing that, I need to work out how much money I would have to come up with if every one of these options got exercised, which is highly unlikely, but let's have a look at the worst case scenario. So on ANN, I sold 4 contracts, contract size being 100, at a strike price of $23. Therefore, 4 times 100, I would have to buy 400 shares at $23. BHP, I sold 2 put options with a contract size of 112, because these are European options as opposed to American options, which I've already talked about in a previous video, means I would have to buy 224 BHP shares for $44.60. I sold 10 contracts on Bank of Queensland, times 100 of course is 1,000 shares that I would have to buy, 400, 1,500 and 2 times 100 is 200 Rio shares. Now in each of these examples, for example the ANN shares, I've sold 4 contracts times 100 means I would have to buy 400 ANN stocks at the strike price of $23. 400 times 23, $9,200 is my potential exposure, meaning I would need to come up with $9,200 to buy 400 ANN stocks at $23. But given that ANN's last traded price was $23.50, I'm still nowhere near being exercised at $23. Why is somebody going to sell their stock to me for $23, 400 of them, if they can get $23.50 on the open market? So $9,200. BHP, I need to buy 224, worst case scenario. Stocks at $44.60 is close to $10,000. You get the idea. 5,750, 10,200, 7,500, and $23,202 if Rio were to be exercised at $116. But given they're currently trading at 119, close to 120, that's not going to happen. And the expiry date being the 21st of the 3rd, today's the 9th of the 3rd, Rio's going to have to fall a fair bit for me to be exercised at $116.01. So the bottom line is, my worst case scenario, if all of my options were exercised, I would need to come up with $65,842. But remember, these are all stocks that I sold cash secured puts on with the intention and the view that if I were to be exercised, I'd be happy to own the stock. So in other words, I'd be happy to spend $65,000 and buy all of these shares. Obviously, I need to have the $65,000 to do it, or my broker wouldn't let me get into these trades. So yes, you do need to have the money in your account because there is a likelihood that you will be exercised. So the next thing I need to know is how much money have I collected, the exact amount, over the last week and a half or so to work out my percentage return. So if I go through each of these stocks, I can then work out how much money I've been paid already. So on the 5th of March, I sold ANN 4 contracts for $204. After brokerage and costs, I ended up with $168.48. BHP was $394.24, but after costs, I ended up with $359 in my pocket. Bank of Queensland, in my pocket, after costs, $173.62. Fortescue Metals, after costs, $132.48. Qantas, after cost was $142.90. And Rio was $256, but after costs, I ended up in my pocket with $220.76. So if I add up the total amounts of money after costs, how much I actually ended up with in my pocket, 168, 359, blah, blah, blah. I ended up with $1,197.24. So close to $1,200. Now, if I take my total exposure of close to $66,000, divide it, meaning the $1,197.24 divided by the total exposure of $65,842, that's 1.81%. That's not bad. For less than 2 weeks of trading, not even a month. Meaning I sold some put options last week and I sold a few late the previous week. 6 options in total, or 6 stocks that I sold options over in total for 1.81%. Now the month's not over and I could do more trades. I could close out some of these positions, whatever. But at the moment, all my trades are open and none of them really look like being exercised anytime soon. So ANN, I sold 4 put option contracts with a strike price of $23. They're currently trading at $23.50. Remember, I'd already determined that there was a bit of support around $23. I thought it was going to turn and go back up, which is exactly what it's done. It's at $23.50. I'm not being exercised at $23 if this trading price today is currently $23.50. Now BHP, yes, I probably could get exercised on this, but remember, this is a European style option, not an American, which means they can't actually exercise me or force me to buy 224 BHP shares at $44.60 until the 21st of the 3rd. Now, are they going to put them to me for $44.60 if the current market price is $43.95? Yeah, of course they are. So I'm saying I will give you $44.60, which is around here somewhere. Okay, now it's very close. We're currently trading at close to $44. So if BHP turns over the next few days, that option is going to expire worthless. If not, I'm going to spend $10,000 and buy 224 BHP shares at a price that I'm happy to buy them for. I mean, look where they've come from. They've fallen from $51 or so. Of course, I'd love to buy them for $46. So I'm not concerned, not worried, happy to do the trade. Bank of Queensland. Is anyone going to sell me Bank of Queensland shares for $5.75 if they can sell them for $6.21 on the market? Hell no. No way. So $5.75 on Bank of Queensland? Yeah, that's not happening. That means the market has to fall down here. Remembering when I sold the put options, I'm like, yeah, there's some support around here. I think the stock's going to turn and go up. Well, guess what? That's exactly what it's done over the last few days. So $5.75 is my put option strike. The market's taken off. It's up at $6.21. That's not being exercised. Fortescue Metals, strike price of $25.50. They can get $25.96, close to $26 on the market. I'm not being exercised on Fortescue Metals anytime. 25.50's around here somewhere where I said the support level probably was based on the old levels of resistance. So I sold a 25.50 put option. The market's still floundering, but it's close to 50 cents away from my exercise strike price. It's not going to happen. Qantas is trading at $5.16. That's 16 cents away from where I have sold my put options, 15 contracts, for an exposure of $7,500. So at $5, yeah, that could happen, potentially. The market's taken a bit of a fall from its previous trading zones. Is someone going to put their stock to me at $5? Not this week. Not today. Well, today's Saturday. That's probably going to continue up. If it doesn't, I get to own Qantas for $5. Happy days. Rio. I mean, you got to remember, this is a very passive trading strategy. I mean, this is certainly no day trading strategy. I'm not sitting here glued to the screen watching this. Today's Saturday. I've just let these trades run. I've collected close to $2,000 in the last week and a half or so, and now I'm just sitting on these trades. I've got the $2,000. I'm getting on with my life. Rinse and repeat. I'll do the same thing next month and the month after and the month after that. This is just passive additional income. I mean, yeah, I do trade as well. I buy and sell shares, as well as I sell cash secured put options. I sell covered call options, which is another strategy I'll talk about. I buy and hold stocks. I dollar cost average into stocks. There's so many strategies that you can use, but this is a really good one if you don't have time to sit and watch the market and you'd rather be doing other things. This is a great strategy for that because it's very passive. Not much happens, particularly in the Australian market where I trade. It's like watching paint dry. You get into a trade, you get on with your life. This is literally making money while you sleep kind of scenario. It really is. Okay, Rio. Am I going to get exercised at $116.01? No. Why? Because you can sell your Rio shares to the market for close to $120. You're not going to sell them to me for $116. On or before the 21st of this month. Given today's already Saturday, there's only about 7 or 8 trading days between now and when these options expire worthless and I just get to keep the money and rinse and repeat. It's not happening. So Rio, strike price $116. Let's have a look. Yeah, that's down here somewhere. Remembering it was through the tops of previous resistance, which became new support. Yeah, look, I mean, the stock has dropped. Is it going to drop down to 116? Who knows? I don't have a crystal ball. I can't predict the future any more than you can or anybody else can. What I'm doing is I'm playing a safe strategy, saying that, look, if Rio does go down to 116, give me $23,000 worth, please. I'm happy to own Rio at $116. I mean, clearly people are trading all day, every day. Some people were happy to own it at 130. Someone was happy to buy them at 135. Me personally, I'm thinking, yeah, I'd like to own them around about the old support and resistance levels, $116. Is it going to happen in the next 7 or 8 trading days? Potentially. Who knows? Regardless, I've already been paid $220 to sit on the sidelines and watch it happen. So I've already got $220 of someone else's money to put toward the trade anyway. It's a win-win scenario. The bottom line is this. If I can make 1.81% return on my money in less than a month, that's an awesome rate of return. Imagine if you could do that every month, starting in January, going right through to December. If you can do this continually, make 1.8% on your money, month in, month out, you're going to make over 20% on your money per year. You're not going to get that in any bank. Let's imagine you started with $100,000 and you were making 1.8% per month. You could do better. You could do worse. But let's go with 1.8% because it's realistic. I've shown you how I've just done it. Let's say you started with $100,000. Well, at the end of month 1, you've made $1,800. So month 2, you take the $1,800 and you compound it. Month 3, month 4, and so it goes. By the time you get out to month 12, because you're compounding, you're not making $1,800 a month, you're making $2,200 a month by month 12. So your gain by month 12, you're up about 24 grand. That's 24%. The further out you go, the bigger and bigger this just blows up. This is the magic of compound interest. I did this little spreadsheet just as an example to show you how powerful this is. So as we saw here, starting with 100 grand, making 1.8% per month. By the end of month 12, you're at $123,000. That's year 1. If you did this continually, in year 2 you'd have 150 grand. Year 3 you'd have 190 grand. You've just about doubled your money in 3 years. By year 5, you've almost tripled your money. This is the magic of compound. It just snowballs. Have a look at this. By the end of 10 years, if you did this for 10 years consistently, your $100,000 has grown to $850,000, 615. That is crazy. So that's $750,000 increase in the 100 grand that you started with. That's insane. So if you take that and average that by your 10 years, $750,000, a 750% return divided by 10 years, that's an average of about 75% per annum. You see how the averages work now. And that's just going to go and go and go. So hopefully you can see the power of that. I mean, I know these are all what-if scenarios and pie-in-the-sky case studies, but they're real. For some people, they're real. This is exactly how some of the world's best investors make massive amounts of money. It's through time and compound. You can see that starting with 100 grand and only making $1,800 in month one doesn't seem that enticing. It's only $1,800. You could spend that quickly and easily. Can't even buy a car with that. But if you compound it and let it grow, well, suddenly, you know, in year 10, you're not making $2,000 a month. You're making close to $15,000 a month. And suddenly this whole, oh, I made 20% per annum, that's an awesome rate of return compared to anything else. Well, the longer you let that grow, suddenly you're making $750,000. That's 75% per year on average. It's not 23 because you've let it go, and so it goes. I mean, just for fun, let's blow this out a bit further. We're at month 120. We'd be at $1 million, just over $1 million by month 130. So that's 10 months later, so less than 1 year. You can see you've gone from 850 grand to suddenly over $1 million. And you're at $1.5 million by month 152. So that's only 12 years, 12.6 years. So you can see the craziness of this. Instead of going from year 10, you know, you don't have to wait another 10 years for that to grow. You're now at $1.5 million in another 2 years. The longer you leave it, the more it snowballs. This is crazy. And I'm getting a little bit excited and a little bit off track. Today's Saturday. I'm checking my shares. Everything looks good. I have a potential exposure of about 65 grand. I've pulled down close to $1,200, which is 1.8%. I may even look this week to throw some more money at the market. Obviously, the more money I can get into the market, the bigger my returns will be. Subscribe to the video. Hope you've liked this one. Let me know in the comments below if there's something that doesn't make sense to you or something you'd like me to cover off on. And I'll be checking these stocks and these trades in the upcoming days. And I'll keep you posted on how they turn out. Thanks for watching.